If we go to $10,000 gold, silver could be at 1,500, 15 to 1, or it could be a bit less, but it will be a lot higher than we're now, and it's going to outperform gold because it does so in major bull markets in precious metals.
And not just China's again, China and its partners. It's very methodical. It has been ahead of the curve in all of these hard assets in terms of its build, in terms of its strategy. There are moves to catch up with that, of course. Europe's way behind. The U.S. is trying to get on board. But definitely China has at this point, a tailwind towards accumulating partnerships and power.
The global monetary system is entering what many analysts characterize as a third major reset, a period marked by profound financial, economic, and social upheaval that fundamentally reshapes how wealth is distributed across generations. Historical patterns reveal that each major reset follows an extended period of excessive debt accumulation, inflated asset valuations, and political complacency. The Dow to gold ratio, which serves as a crucial long-term indicator of systemic balance, is once again declining sharply, mirroring the dramatic drops witnessed during both the Great Depression and the stagflation crisis of the 1970s. As fiat currencies continue losing purchasing power through relentless monetary expansion, the next phase of this cycle appears increasingly inevitable, characterized by a return to sound money principles, with gold and silver reclaiming their historical roles as anchors of genuine value. Financial experts Mario Innecco and Nomi Prins emphasize that these monetary resets are not random occurrences, but rather policy-driven outcomes resulting from decades of structural mismanagement. While policymakers continue inflating the money supply to maintain political viability, the real cost is borne by ordinary savers and wage earners, whose purchasing power steadily erodes. The current phase closely resembles the late stages of previous debt supercycles, periods when gold consistently outperforms all financial assets and silver amplifies those gains as public confidence in fiat currency systems collapses. Investors who fail to recognize this fundamental shift risk becoming trapped in nominal illusions while actual wealth migrates decisively into tangible physical assets.
And as you can see, we're still in breakout mode, and we're still far away from where we were back in 2011. I think the gold-silver ratio got down to like 31, and as you can see, the silver was just over 3% of the price, which makes sense. And then if we look at a more long-term chart of that, the silver price as a percentage of gold, if we go back to 1980, yes, that was around 6.5% of the price, which takes it to around that 15 to 1 level. So you do the maths. If we go to $10,000 gold, silver could be at 1,500, 15 to 1, or it could be a bit less, but it will be a lot higher than we're now, and it's going to outperform gold because it does so in major bull markets in precious metals. The one in the 70s and the one from 2001 to 2011, it did so. So we're still early days here for silver, I would say. That's how many ounces of gold you need to buy one Dow Jones Industrial Average. And you can see that I've got reset 1. Well, that happened in I think it was 1932 or 33 or thereabouts. And the Dow gold ratio dropped to around 2. So in 1929, it topped just around 20. That's when the price of gold was $20.67 per troy ounce. Of course, there wasn't a price of gold because gold was money at the time. And the Dow went up to I think almost 400, so it was like 20 to 1. And then we had the 29 crash and the final bottom in 32. So that's when things reset. And then Roosevelt came in, devalued the dollar, revalued gold in 33. So this is the reset period is a period of great monetary, financial, economic, and even social convulsion. And I think we're right in it right now. So let's move forward. After that first reset, what the reset does, it allows the credit system to restart again. Yes, the Great Depression led to loads of bankruptcies. People unfortunately going broke. And then things started picking up again. Of course, it wasn't a straight line. And by the year 1966, we had another post-war credit boom. And I think the Dow topped, the Dow gold ratio topped around 26. And I think the Dow topped probably around 1,000, I think. And then for 14 years until 1980, it pretty much went sideways above and below that level. And the reason this ratio dropped from 26 to basically 1 in 1980 was that the Dow went sideways, or maybe even some stocks went up a bit. But gold went from $35 per troy ounce to $887.50, which was the high in January 1980. And that completed the reset. The debt to GDP at the time was 35%. Yes, there was a big recession, a double-dip recession in the early 80s. Reagan took over and things changed. And ever since then, we've had a massive boom, financialization boom. And technically, though, this credit boom that started in 1980 ended in 1999, 2000, late 1999, when the Dow gold ratio topped just around 45, as you can see here. And ever since then, it's been going down. Yes, there was a rally, a correction back up when they threw everything at it to save the system. And by that I mean loads of QE, loads of borrowing, trillions and trillions upon trillions. You can see they did it again in 2020 when things are starting to crash. But now, as you can see, and this is a monthly chart, of course, we're keeling over. And I don't think we have much time. And by that I mean about 4 years, I would say, because if you look at the 1980 reset, we saw the Dow gold ratio rebound from the mid-70s up until, let's say, well, I think it was around 74 to 76, sharp rebound. And then it dropped, and it took 4 years for that drop to occur. And I think we are keeling over. So it could be 3 to 4 years from now, and that would take us to the late part of this decade. Some people see gold continue to go higher up until 2032. Who knows? But I think reset number 3 might go past 1. And what will that mean? Well, that will mean, for example, if we go to 0.75, that you will need 0.75 or 3/4 of an ounce to buy 1 Dow. If it goes to half, that means you need half an ounce, and so on. At what level will we be in terms of the Dow and gold? Well, it's difficult to say, but I tend to think it's going to be a lot higher for gold, because they're going to keep inflating the system, because they can. In a fiat currency system, they can. And there's no stopping them, because politicians, they want to be reelected. So they will always lean towards more inflation. And we're seeing, despite the fact that Trump hasn't been allowed to sack Lisa Cook, that Trump has a lot more influence now. Central banks are losing their independence. Not that I believe they ever had it. If they were really independent, they wouldn't have saved the system in '08 and in 2020 when push comes to shove. Yeah, they become political. So that's the way I see it. Gold is the only way to protect yourself against the currency crisis of the major reserve currency, i.e. the dollar, because technically the dollar used to be as good as gold. So we have to do like a regression theorem analysis. So that's the only way to protect yourself. And it's not just the dollar, of course, that's going to go. It's all fiat currencies. So that's that. So I've got here another Dow gold ratio chart. It's a weekly one and it's more short term. So you can see what's really happening now. We had a rally in the Dow relative to gold since April, but now we've broken this rising wedge, which is very bearish for the Dow versus gold. And it looks like we're going to dip a lot lower in the short term. Of course, 1-to-1 or less than 1-to-1 is probably 2, 3, 4 years away, or who knows, it could be very quick. But we will know when it happens because it will be 1-to-1 or even less. That's the way I see it.
The transformation of global gold markets has moved beyond theoretical discussion into observable reality. The London Bullion Market Association maintains its current dominance, particularly through its long-established standards ensuring quality and credibility in gold trading. However, the Shanghai Gold Exchange and related Asian vaulting networks are quietly but fundamentally reshaping global gold flows and ownership patterns. Increasingly, nations are choosing to store and transact gold within their own jurisdictions or neutral territories, pulling reserves away from London toward emerging hubs in Shanghai and Singapore. This strategic shift provides both enhanced security and greater independence from Western financial policies, which are increasingly perceived as politically vulnerable and potentially weaponizable. The practical effect of this eastward migration is that more physical gold is being removed from active markets and secured in long-term reserves, creating a tightening effect on available supply precisely as global demand surges. This dynamic not only supports higher prices, but fundamentally transforms the structure of gold trading itself. The movement of gold reserves toward the east represents a fundamental rebalancing of monetary power, one that strengthens alternative systems for international settlement and reserve management outside traditional Western control.
LBMA definitely has the current lock, and it has the quality lock in terms of the way in which its regulations persevere over the quality of gold that's used in transactions. And the Shanghai Gold Exchange and the other mechanisms that China's been building and investing in will also have a very high quality, high grade of gold. They're not actively interested in competing with low grade. So what that's going to do is it's going to generally increase the trading of high quality gold around the world in terms of time zones, in terms of physicalities, in terms of storage. Now, when you look at some of, for example, the Middle Eastern nations, whether it's Saudi Arabia, whether it's Iran, who we don't even actually know how much gold they're officially buying because it's not all exposed or transparent, but you see nations moving their gold supplies more away from London and into Shanghai, into Singapore, which is another big evolving gold hub, in order to be able to achieve that jurisdictional neutrality, to basically keep their gold away from other policies that could impact them. And so what does that do for the price of gold? It lifts the price of gold up because what you have is more demand around the globe and you have more stored gold. So once you're taking gold out of supply, two things are happening. One is there's not enough supply to basically meet the demand for gold in general as we move forward. And that, just by general economics, will have a factor of moving gold upward in terms of price. But you also have more gold locked away. So the idea of keeping gold locked away in secure vaults in this growing regional zone also means you're taking physical gold out of the physical market. And so that also creates an additional demand versus supply edge toward the demand for gold. So now you want more gold to basically accumulate into that stored supply, into that vaulted supply. And then you have the idea of timing. More countries, more institutions, more high net worth individuals, more family money groups have the access to an entirely secure additional time zone element to buy gold. And that creates more liquidity for gold, and it creates more availability of trading for gold. And so what we'll see probably is more of the volume moving towards these new hubs as all of these things happen, each of which are positive for the price of gold. So the fact that we've seen gold now like 3,900s as we speak, we have forecasts in the beginning year of 4,000. We moved our forecast for this year to 4,500. But we are basically seeing a massive push towards the east, which is going to entail more demand for gold and less supply physically relative to what's underground. So therefore also more demand for miners of high quality gold projects. Yeah, so we had called silver at 50 also at the beginning of the year, and we haven't yet, but I'll say here we are looking at moving it to 60 by the end of this year for not the same reasons as gold. Obviously, part of the silver attraction is the fact that it has a historic link to gold, and when gold moves up, it tends to move up more securely than silver, and then silver overtakes it, and then silver all of a sudden overshoots it. Silver has had some headwinds in terms of economic growth and industrial need, but it's also now seeing a lot of tailwinds basically from countries like China, from countries like India in terms of solar and new wave type of energy, and also in terms of our own infrastructure, in terms of building plants, in terms of building out our energy grids, and that also requires copper, but silver is a component of that as well because of its conductivity. So we're going to see that demand on twofold basis for silver, from an industrial capacity need. Again, not enough supply in the ground. We're at a 2-year running deficit of supply in the ground versus what we have available, and moving in terms of its relationship to gold as gold continues to move up. So we're in a definite not just bull market, we're in a new cycle in terms of a bull cycle for these precious metals, for their geopolitical uses, for their trade uses, and for their physicality. We're tilting towards a non-US, non-Western focus on not just the accumulation of gold. We've been seeing that in central banks around the world, particularly led by China, but not exclusively, throughout the BRICS community, throughout Eastern Europe, and so forth. But what China has been doing is very carefully sequencing a set of moves that really started about 10 years ago with its adoption, the yuan's adoption into the SDR, into the IMF's currency basket for the first time. And all of the moves that have happened since, the accumulation of gold, the deceleration of purchasing of U.S. treasuries and dollars, the now physical push behind a vaulted, digitalized in terms of technologically advanced vault system to accumulate gold buying, gold storing, and gold's future into the East. This has all been part of, I don't want to use the term plan in terms of master plan, but definitely strategy to move the center of gold, and therefore the center of trade, of currencies, of solidity, of jurisdictional neutrality into more of an Eastern focus. It is both of those things. It's the accumulation of power through both of those things, and through the accumulation also of gold, of a diversification towards the dollar, yes. Western currencies, yes. Gold is now the second most held reserve hard currency in terms of all central banks globally, just behind the dollar, ahead of the euro as of this summer. And it's the idea of centralizing power through the accumulation and repositioning of where gold is stored, how securely it's stored, how it's not touched by not just the dollar, but Western policies. This is about a redistricting, really, of the globe around the hard currency of gold. And it's one of many strategic moves by China and by non-US, not non-Western nations, although some Western nations are, of course, also accumulating gold in the wake of all of this. We know gold is not magically moving past 3,900, but there has been a solid purchasing of gold by central banks, by Eastern investors, by now Western investors starting to get more on board with it. But it's about power. It's about saying, look, we want to have the ability to create this overlay of hard currency, which is gold, whether it becomes a gold standard or whether it's simply the idea that gold in central banks means solidity, mean power, mean dollar diversification. That's what China wants to do. And it's put a lot of money behind this. And there have been steps that have moved towards them courting foreign central banks around the world to store gold in Shanghai or in these new hubs via the Shanghai Gold Exchange, the SGE, and other mechanisms. Of course, the U.S. has a stockpile of gold in general, but it doesn't use it in terms of central bank solidity like China is doing, like Russia is doing, like other BRICS nations is doing, and Eastern European nations are doing. So there is an awareness. For example, we have seen that gold is now considered a critical mineral in terms of how the White House views gold relative to tariffs and in terms of excluding certain gold purchases from general global tariffs. And that was a move that happened after they were included and they were excluded because someone in the White House was like, wait a minute, we need to be able to actually have a flow of gold that isn't, taxed at a ridiculous rate. So there is an awareness, but I think it's an awareness after the fact. And as a result, China's had this head start, particularly again over these last 10 years, and more so since the Russia invasion of Ukraine in 2022, when it was basically seen by Russia, by China as one of its partners in trade, that at any point in time, currencies or bank accounts can effectively be frozen. And if you have a physical stockpile of gold that can physically be maneuvered into liquidity at any particular point, well, then you have the power to circumvent such external hits to your policies, to your power towards your economy.
Gold's transformation into a steadfast global reserve anchor is accelerating faster than most market observers realize. The shift of physical holdings toward Asia transcends simple diversification strategies, representing a fundamental pursuit of sovereignty, control, and insulation from Western monetary risk. As gold moves eastward, its status is being elevated from a mere asset class to a strategic instrument of national power with profound implications. As supply tightens with more metal remaining in long-term storage, liquidity becomes increasingly regionalized, and the balance of financial influence gradually but inexorably shifts away from traditional Western centers such as London and New York. The quiet, deliberate construction of this new monetary system, centered on high-quality, fully allocated physical gold, signals a long-term structural transformation in how nations store and value wealth. This is not speculation or financial theory, but concrete infrastructure development. The East is systematically building a monetary bridge backed by tangible assets, while the West continues relying predominantly on credit and financial leverage. These competing models will ultimately define the contours of the next economic cycle, where confidence and physical settlement regain dominance over abstract financial engineering. We are witnessing a monetary realignment that extends far beyond simple price targets or market forecasts. This is fundamentally about the architecture of power itself, and gold is returning to the center of that architecture as the foundation of a new global monetary order.